Sticker shock stumble in real estate markets. Unbelievable. Houses investors sell for over $1 million, and the median home price in North County, San Diego is $1 million. Have we reached the top of the market, and might we enter into a recession? And will that mean lower home prices? This is the topic of this video. What am I saying? Recession. It's all over the news, the YouTube channels and social media that the curve has inverted. What do they mean with that? It's practically the 10-year minus the 2-year, with the red bars indicating every time it inverts, we enter a recession. Now, as you guys can see, it did touch in like 98, 99, and we did not go into one. Currently, we're very close of inverting. Will we see a recession? My name is Lenska. I'm a real estate broker and also consult people with their ADU projects. And I'm here to give you a realistic outlook on the real estate market with graphs, stats, and facts. And all I want to help you build your fortunes. No fortune telling here. So what do consumers and the bond market are thinking? Currently, the consumer sentiment indicates that consumers don't feel good about their finances. It's actually today at its lowest level if you look at the orange line. Looking at 1998, the consumer sentiment was at one of the highest levels. Today consumers hate the economy, and the consumer is saying a recession is coming. The bond market is saying there is a recession coming, aka I just explained the inverted yield curve. And also other recession indicators are flashing recession, right? Gas prices, inflation, affordability, those are all forward-looking indicators flashing a recession. And to all of this, what means inflation? We can see that the stock of consumer credit outstanding expanded by nearly 42 billion in February, nearly tripling consensus expectations for about 15 billion gain. So America have never loaded up their credit card bills as much as they have done in February to afford their lifestyle. Not only do we have a negative consumer sentiment, there's also an HPSI, a housing sentiment that Fannie Mae asks every month, and the index is down 8.5 points year over year. And that is practically because the decrease in that HPSI can be attributed to a net decrease in 4 components this month. Buying condition, it has never been that bad if you're looking at the -11 and -62 year over year change. And also the job loss concern, obviously home price outlook and mortgage rate outlook. We all 69% believe that mortgage rates will go up. So there were net increases in 2 components, practically selling conditions. Sellers still are on cloud 9, and the change in household income, which is not inflation adjusted. So thank God we saw an increase in that, because it is all eroded by inflation. So at real household income is actually down. So this month just shows you how far apart the buyers and seller expectations are. Median sales price and recessions. So that's one thing not to worry about, as well as you can follow the curve, except obviously a housing in induced recession. You see the prices were going down and we entered a recession. So, but house prices and real estate were really ticking up nicely. There were little blimps in each recession, but nothing major. Will we see that the same again if we have a recession, to have home prices leveling off? So far, nothing is leveling off. We see a strong, about 20 to 25% increase or in appreciation between the home prices, and for detached and even attached, we have still a very fast moving market, 19 days from active to pending. Obviously, the pending sales are down and sold listings are down because we simply have less inventory. But look at that square foot price in San Diego at 617, which is up, because this is the average, it's up 28%, up from January 540, okay? And we have months inventory of 0.6, which means we got about 20 days of inventory. Now it looks a little bit different in LA, just to give you a little bit comparison. LA is appreciating between 10 and 14%, and price per square foot lays at 610. Still same quick selling market, but we have a very distinct pattern here of leveling off, increasing. And when we're looking at the last 2021, right, the inventory, it practically leveled off in May, very early, and the median home price didn't take up until beginning of this year. So we obviously want to know, are the prices going down? Are we going in a recession? So what would be the first indication of a slowing market? Obviously, everybody starts searching online, right? You will see, and you already have seen a dip in Google searches. We've also seen less activities on open houses, and at open houses, as well as the model offices at the home builders. We will see showings per listing to go to contract, and price reductions, active market time, and drop in home buyers contacting online broker services like, you know, Zillow or Redfin. Decline in mortgage applications, especially in pricey California metros. And let's take a look at stock prices of real estate related companies. And certainly increase in mortgage rates. We actually hit over 5% as the day of recording, February 19th. We are up not just 4.5 but 5%. And just, I don't want to rub it in, but just, don't you get the mortgage envy? If you purchased a home in late 2019 to early 2020 with a medium home price of $600,000 and you put 20% down, your principal and interest was about $2,000, right? With a loan balance of $480,000 at just under 3. 2 years fast forward, the median home price was $800,000. You put 20% down, you have a loan balance of $640,000, and your monthly payment is nearly $3,400. Now I'm asking you, did your salary or your income increase by about, what is it, 80% or 75%? And we can see that still year over year we have a very competitive market. So it looks like 105.1% above list price, okay, which is up 3.1%. Now, I'm the boots on the ground, and we don't see 20 offers anymore, but we do see 5 or 6 offers. So I would caution you to overbid. unless you have a lot of cash, and in this matter it might not matter because you rather buy some real estate to hedge against inflation. But if you want to look for a deal, we know wherever the inventory is higher, there is a chance you're getting a deal or maybe not outbid. So you see all the coastal areas actually in red, they have still less inventory than last year. But if you look at Riverside or San Bernardino, it's up 28%. Or Merced, actually, there's a lot of building going on in Merced, and you can see that that actually helps with the inventory. Just FYI, the demand for second homes has also plummeted. So there might be investors or people that cashed out in the stock market and thought they diversify, and they invested because of the low interest rates, and they were practically sitting at home able to go online and do some research on some good markets. And so that has been definitely flattening out, and so the demand drops, which means there are also less offers from investors. When we look at some of the new homes, actually the new home sales are down 3 months in a row, meaning there's also less demand. We also see that the purchase mortgage applications dropped dramatically from July being up, at 700, down now to like 400. So that is definitely a big decline. And then, like we said in the slide, you figure out once people cut their prices. So I see a lot of houses where sellers think, oh, let's see if we can get that price. So these are priced too high, and they actually sit and they will get a price reduction. Now we see there is less foot traffic, and here's the proof for that. In March, during the heights actually of the COVID crisis, we had about 17 people look at each listing. So now actually we have less people look at it, but it also takes less to go to contract. But I find it interesting that when we were limited to in-person viewing, that we had many more showings actually than we have right now. We can see that we outgrow, that we have a sticker shock, because if you have to spend 73% of your mortgage as for your salary in a mortgage payment, which is different than your hourly earnings, if it only goes up 11%, that doesn't make sense. So the salaries and earnings practically don't keep up with the mortgage payments in Austin, and we see these overheated markets where we actually already see an inventory increase in all of these markets: Austin, Boise, Phoenix, Seattle, Atlanta, Nashville, Las Vegas, actually Los Angeles as well, because we had a lot of out-migration out of Los Angeles. But meaning, this is an interesting stats. I think we're saying the jobs on earnings don't keep up. So we can see that if the stock market does well, people quit their jobs, say practically shove it. But what happens if the stock markets go down? It probably will push people back into the labor force. And you're not faring better if you have to rent, because rent is up about 32% year over year, and an average apartment right now is just under $2,000. And you can see by the heat map here, the dark purple are the most expensive markets in rent, but so are also the median home price, and it's all relative, right? And we talked on one of the points where we know maybe that Wall Street knows more than we do if we will see a recession, or median home price is going to adjust. all of the above companies right here, Redfin, Open Door, Zillow, and Compass, all stock prices went down, right? And it's even more interesting that all these didn't even make a profit in 2021. The only company that actually made a profit was EXP, which is another brokerage company. And so that share was actually from 51 a year ago down to 26%. So and we can kind of see that the trend line of all those house-related stocks are practically down. Now, we're all watching what the Fed will do, right? Because they have practically, I call it manipulate the market, because they can raise or lower the interest rates. Yes, it's an election year, and the Fed has a lot of pressure of getting the inflation down, because we're all voters, not just Wall Street votes. But let's see which vote counts more. So they have three choices. They can tighten just enough to squelch inflation and maintain GDP growth, which would be obviously the best outcome. Or the Fed doesn't do enough and inflation gets worse, or doesn't come down as fast as the market or anyone else would like. And that would certainly push us in a recession, and definitely would have an effect on housing prices. If the Fed eventually does too much and we swing from high inflation to a recession, and a recession by itself is always deflationary. So it actually would do the trick, but it is always accompanied by demand destruction, which we kind of need in the housing market since it's really overheated and normal families can't afford a house. And if you do want to have some more education, I teach a class the third Saturday of each month. You can join us on Meetup, Real Estate Investing Field Trip. We showcase investors and their projects. It's a hand-on, out in-person event. Thank you for listening, and I will see you on the next one, and go make some money.